Welcome to the Executive Real Estate Investing Show. This podcast is for you, the busy business owner or executive looking to create generational wealth. Here, we're going to show you how to do that through real estate investing, from multifamily to industrial and everything in between. You will become a real estate investing expert. And now, here's your host, Michael Holman.
Welcome to another episode of the Real Estate Investing Show. I am your host, Michael Holman, and thank you for being with us today. Super excited to get started. Like always, we want to start with our executive tip for the day. And this one is a theory that I have established myself. So if it sounds crazy, it's probably because it is. But the executive tip for today is to learn how to be perfectly content and perfectly hungry or unsatisfied. Sounds like polar opposites, right? Sounds like they're competing, sounds like it makes no sense. But I argue, and will make the argument, I think, till the day I die, that you can be perfectly content with the things that you have while still always knowing and understanding and striving for more and more in your life. So don't ever forget that. Remember, you can be perfectly content and perfectly unsatisfied at the same time. So executive tip for you is learn how to do that, right? It's something that I firmly believe and think that it'll help a lot with you in your business and in how you run things. We are going to get right into real estate investing today, though, because we have a great show and it's filled with some legal language, right, and some legalese. So it's really important. So do not zone out on me too much through this episode. Okay, the reason that we decided to do this episode in the first place is we have a lot of listeners and a lot of followers who are passively investing in real estate syndications all the time, right? And so we decided to dedicate a show to just some of the very basics of real estate syndications. And we're planning on doing a whole big series here in the future, but for now we just want to start off with some of the basics, right? And understanding there's two main types of syndications, right? The first type is a 506B, second type is a 506C. Not exciting names, right? Those are just the regulations, the code in the SEC guidelines and where these are found. So, but they're commonly known as 506B offerings and 506C offerings. And like I said, a lot of our followers, a lot of our listeners are passively investing in real estate syndications all the time. A lot of people who listen to us, have invested anywhere between one syndication to 20 syndications. And so we want to make sure that we're appealing to that crowd and their understanding, right? Because syndications in general, they're a great way to invest in real estate. I'm a big believer in real estate syndications. I'm in real estate syndications myself, both as an active investor and as a passive investor, right? They're so great because you receive all of the benefits of real estate investing without the headache, right? So you get a benefit from the leverage, you get the cash flow, you get the appreciation, the tax benefits, right? You get so much more investing in syndication, investing directly in the real estate. But like I said, you're not dealing with the headaches, right? You're not dealing with a rental property. You're not landlording. You're not being called in the middle of the night to go fix toilets, right? As everyone likes to say. We've worked with tens, if not hundreds of investors who are just tired of being landlords, right? And so they come into this syndication model and to be quite frank, most of them love it because they don't have to do anything, right? They get just as good, if not better returns than they got in their rental property, and they're not doing anything. So big fan of syndications. I think they're one of, and arguably the best way to invest in real estate. But that being said, when you start to seriously look at investing in real estate syndication, there really are a number of items. It is passive, and every once in a while, right, you find a sponsor that you really like, you trust, You develop a good track record and you just start to trust them, which is great. But when you're getting into real estate syndications, you're getting into investing in real estate syndications, you need to understand some of the items and some of the nuances, right? You need to be able to know what questions to ask. Well, one of the things that you need to understand right from the beginning is this a 506B or 506C offering, right? Most passive investors who are passively invested in a syndication, they're just blindly looking at return numbers, and they're honestly completely disregarding all the assumptions, all the important information, how the deal is structured. So do not be this person, right? Do not just blindly follow everything you hear based on what somebody tells you the return is going to be. I'm a CPA. I have a financial background. I can tell you with certainty, I can make pretty much any investment look good, right? To be perfectly honest, right? It's not like there's this set, hard, fast set of rules. If somebody isn't digging down into the assumptions, I honestly could make any project on planet Earth look good. Well, obviously I don't do that. I pass on a lot of projects, and we have a very high standard for the projects that we do. But if you get with somebody who's not necessarily that trusting, or is kind of fudging, or is getting really aggressive, all of a sudden, the numbers that you were told you were gonna get and the returns that you're gonna hit are not nearly as close as what actually happens, right? So like I said, do not be this person. Understanding the difference between these two syndication types is one of the first steps. So, in an attempt to help you be an informed investor, right, an informed real estate investor, we are going to start with just very basic concepts about syndications. So, as I said earlier, most syndication investments, they're either classified as a 506B offering or a 506C offering. For those of you who are new or have newly invested in real estate within the last about 8 years, you've heard these terms probably most of the time that you've been investing in real estate, right? 506C offerings, they really came around in 2013. That's when they were created, because prior to that, this was just known as Rule 506 of Regulation D, right? It's the same thing as what we know today as 506B offerings, but prior to 2013, it was just Rule 506. So the main difference between the two and why this was established was the ability to solicitation, right? So let's start with the old rule, 506B, and let's just talk a little bit about that. So under 506B, sponsors are not allowed to generally solicit investors, right? So if I have a real estate investment, let's say I'm developing a multifamily project in one of the markets in Phoenix, right? That's one of the markets that I'm in. I'm developing a new 200-unit multifamily project in Phoenix. I need investors. But let's say I did it as a 506B offering. I'm not allowed to just go post internet ads. Nope, I can't do billboards, right? I can't just go out and solicit. I can't just market. I can't run a television ad, right? I mean, I don't know many syndicators that are running television ads, but I'm not allowed to do any of those things. And there's some important reasons why. So sponsors can allow an unlimited number of accredited investors and up to 35 sophisticated investors. So this is just another one of the rules. So first rule, can't generally solicit. Second rule, you can have an unlimited amount of accredited investors and this limited amount, 35 sophisticated investor. What's a sophisticated investor? I have no idea. It is very open to interpretation on what constitutes a sophisticated investor. So maybe some of the other capital raisers in the world have very strict standards, right? It's not Joe Schmo down the street. I don't know, but that rule, that definition has not been defined, right? That term, sophisticated investors, very open-ended. I assume if you're smart enough to seek out and find a real estate investment, I mean, in my mind, that sort of puts you probably in a classification of a sophisticated investor, but who knows? The third rule with a 506B offering, sponsors must prove that they have a prior relationship with the investor, right? So anyone who invests in this property had to have a prior relationship with the sponsor, with the person who's offering the investment. If you're pretty new to real estate investing, or especially if you've been around a long time, I'm sure you started getting some emails, hey, invest in this project. I remember I got one email from somebody who I've never met, I've never had a conversation with, but I got this email randomly that said, hey, invest in my apartment project. It was like a 150 unit apartment project. It's a 506B offering, so you don't have to be accredited. And I had to just start laughing at, that's a huge no-no. I don't know you. I'm not allowed to invest in your project. You should not be sending emails out to me for a 506B offering, because I don't meet those definitions. I've never talked to you. I've never had a conversation with you. How is that a pre-existing relationship? I mean, that person, that syndicator who was trying to solicit me to invest in their project was in direct violation of SEC rules, right? And that's treading on very dangerous water. So be careful with that, right? I mean, the question that I always bring up, or what I say, is even if numbers look really good, even if you're having a really hard time finding a 506B offering, maybe you're not accredited, but you're sophisticated, like I said, whatever that means, but you finally find a 506B offering, and it's because somebody emailed you out of the blue, I would just be really hesitant, right? Because that person, whether intentionally or not intentionally, is completely breaking the rules and the law around the 506B offering. And if they're willing to bend on the rules of a 506B offering, what other rules are they bending? What other things are they being too aggressive on? What other flexibility, we'll call it, do they have in their offering or in the investment? So just a heads up, something to be aware of. If you don't know somebody and they're sending you 506B offering investments, I would just be very cautious about that person. But like sophisticated investor, what constitutes a pre-existing business relationship is very, very open for interpretation. This has not been defined at all, right? So, I mean, prior relationship, is that a LinkedIn connection? Maybe it's a call, a lunch. You got invited to their kid's birthday party. I mean, at what level do we have a pre-existing business relationship? I have hundreds of thousands of followers on Facebook. Maybe one of them is a pre-existing business relationship. So terms here are a little mucky. But like I said, most syndicators, or the common rule in the space that we're in among real estate syndicators, is that they all agree that you've had to have some form of communication, and generally live communication. So not just like an email that was sent one way. I'm talking a live call, a Zoom meeting, an in-person meeting, something like that. That is generally the threshold that I know we hold our standards to, and most other syndicators in this space, that's their standard as well, right? So it's a pre-existing business relationship means that, hey, I have called you or you've called me and we've talked on the phone, even if it's only 5 minutes or 20 minutes or anything like that. We have called on the phone, we've talked, we've had a discussion. We didn't talk, I wasn't soliciting you for an investment. It was simply, I'm just trying to get to know you. I'm trying to understand you. You hang up the phone and you check that off the box. There's a pre-existing relationship. This is really common. I mean, a lot of real estate syndicators, one of the things that they do and one of the steps that they take, and I know we're very similar for the most part, is they want to have a call prior to ever showing you an investment, right? And that's a good practice in general. But the reason for that call, right, as nice as it sounds for them to be having that call, I know this person just wants to get to know me and they want to have a good conversation with me. That is true. If you call me, I do want to get to know you. I love people. I love hearing about people. I want to know what your goals are. It is very, very true that I want to know about you and who you are before you invest with me or before I invest with you. But That's all. There's a dual purpose of that call. And the other side of that call is to be able to check the box on saying, yep, we have a prior relationship with each other. We can now do business together. So just that's a main reason, so you can know that. Now, moving over and adjusting a little bit to 506C offerings, right? 506C is a little different in a couple regards, but I mean, it's very similar. These investments can be solicited in any way, right? General solicitation is the term, and they can do it however the sponsor sees fit, right? If they want to do, like I said, billboards, they want to do a TV advertisement, they want to put it in the newspaper, they want to run Facebook ads or Google ads, they want to post on social media, they can do anything and everything that they can to raise the money to do the real estate investment or to do the project or to do the deal. And while I'm talking in specific terms of real estate investing and real estate deals, this does extend beyond just real estate, right? I mean, this goes into private equity and all sorts of different things, but we're going to stick to the confines of real estate here. So this eliminates a lot of the barriers, right? You do not have to have a pre-existing business relationship or a pre-existing relationship at all to invest in a 506c offering. Now, that being said, do I think it's good to have a pre-existing relationship? Yes, I think you should have at least called, talked, emailed, communicated, done something with the sponsor of that real estate investment before you invest with them. I absolutely think you should. I do it. You should do it too. But it's not a requirement, right? If you are just out there and you're saying, I got $50,000, $75,000, $100,000, whatever that amount is, I got $100,000 and I found an investment and I like it and it's filling up fast and I'm not going to take the time to vet this sponsor or anything like that. I'm just going to go put the money in and be done with it. You can invest and if that person has an investor, like we have an investor portal, you could go right into our investor portal, click on the investment, look at it, get all the details, view the webinar, click invest now, sign the documents, and you're done, right? No communication. Yeah, it's not what I necessarily recommend, but is it possible in a 506c offering? Yeah, it is, right? You don't have to have that pre-existing relationship. Now, here's the caveat, and it's a big one. In a 506c offering, every single investor in that syndication must be an accredited investor. Okay? A little bit different than the 506b offering, where you could have a limited amount, right? Up to 35 sophisticated investors. You don't get that in a 506c offering. And if you don't know what an accredited investor is, we'll talk about that in just a second. But every single investor must be accredited. And generally, under a 506b offering, an accredited investor can do a self-evaluation, right? They can self-answer their accreditation. Basically, they can go in and answer a form that says, check, I'm an accredited investor, sign it, and you're done. In a 506c offering, it's much more common to do a third-party verification, meaning you go to one of these third parties, right? Probably the biggest one is verifyinvestor.com, and the sponsor pays a fee. They should be paying the fee. If they're not, that's a whole nother thing. Generally, the sponsor pays a nominal fee for Verify Investor to reach out to the investor and say, get all the information they need to verify they're accredited. And then Verify Investor sends a letter and says, yep, this person's accredited. We've checked. We're an attorney, so we have the authority to do this. Sign, send it out to all the parties, and boom, you have your accreditation status. So that is that's commonly how that's done. 506c offerings, honestly, are becoming more and more popular, right? I mean, and on both ends, they're becoming more popular because sponsors finally have the ability to generally solicit, right? I mean, in order to even just get started as a sponsor, you had to have this vast network. If you were going to raise $10 million, and it's like, how do I do that with just the people that I know? or have a pre-existing relationship with that, that can be kind of daunting. So it's becoming very popular with sponsors. A lot of sponsors are turning to 506c offerings because they can go shout it from the rooftops. They can go run $1 million in Facebook ads if they wanted, right? They can do whatever they need to do to try and get an investment funded. And there's a lot of power in that, right? I mean, it can be difficult to fund an investment if you can't tell anybody about it, right? So there's a little bit of anxiety that might run in that. So it's becoming more popular with sponsors, but here's what it's doing as well. At the same time, it's opening up more investment opportunities for accredited investors, right? So if you're an accredited investor, 506c is a really great thing for you because more and more sponsors are going a 506c route, which means you have a lot more opportunities, right? And especially coming from smaller real estate firms, right? I mean, if you're a real estate firm that owns under, $500 billion or $500 million in real estate, you're likely willing to give a bigger slice of the pie to an investor to ensure that you get the money. I mean, if you're an accredited investor and you're dealing with a small shop, you hold a decent amount of power in that relationship, right? And that sponsor is going to have to structure that deal in a way that's appealing enough to get those accredited investors, right? And that's different. If you're gonna invest in a company like let's say Blackstone, right? If you're investing in Blackstone, then they're likely taking a lot bigger slice of the pie because they have lots and lots and lots of investors, right? They have investors. I have no idea how many investors Blackstone has, but I can't imagine it's a small amount. I was going to say thousands, tens of thousands, hundreds of thousands. I don't know. Millions? Who knows? But the other difference too, and the other good thing is a lot of accredited investors, right, don't have the ability to fund as much as like a Blackstone or some of these other huge groups are going to require for an investment, right? A lot of times the minimum is going to be like $1 million, right? I mean, a minimum investment of $1 million or $5 million. Well, if you just meet the accredited threshold status, you likely don't have just $1 million that you can invest, right? But these smaller shops, they allow $100,000 investments, $75,000. Usually they don't go much lower than about $50,000, right? So $50,000 is generally going to be the minimum every once in a while. But that being said, another thing that you don't understand is that's up to the sponsor, right? The sponsor decides what the minimum investment is. And so they'll do it, generally the minimum investment is going to be anywhere between $50,000 to $250,000, right? And the only reason for that is that's the sponsor saying the higher the minimum amount, the less money or the smaller number of investors it is that have to be a part of this deal, right? And more investors it's just a lot more time and effort. I mean, if you have 100 investors in a deal, it's a lot more time and effort than if you have 10. So some of the really high-powered syndicators, right? They are going to require high minimums. I think about the highest that I've seen from a syndicator is $250,000. That I see those. That's oftentimes I see those a lot on like the Grant Cardone deals, right? He's got, I think his minimum is generally $250,000. But it gives you all these opportunities, right? So 506c, right, as frustrating as it is, especially if you're not an accredited investor. As soon as you are an accredited investor, or if you're a sponsor, it opens up a lot of opportunities. Okay, so I've been throwing around the term accredited investor a lot, and so I just want to give a quick definition of what that is, so that everybody's on the same page here, right? Because I actually I do this all the time, and there's a lot of questions that I get surrounding what is an accredited investor, what isn't an accredited investor. So an accredited investor is someone, right? We're going to start with individuals. It's an individual who meets one of two requirements. They either have made $200,000 for the last 2 years and reasonably expect to make that in the future. Once again, like most things with surrounding Regulation D and 506 offerings, there is some interpretation on what expected to make $200,000 in the reasonable future or in the future means. The other requirement, in addition to that, not only does it work if it's $200,000 that you make, if you and your spouse together make over $300,000 and have for the last 2 years and expect to reasonably in the future, you're also considered a credit investor. And how this breaks out is if you're someone who makes, say you make $150,000, well, you as yourself don't qualify as a accredited investor. But if you make $150,000 and your spouse makes $150,000, then together you make $300,000. You both qualify as accredited investors in that standpoint, and that's what that means. It could be the same whether it's 125 and 175. It could be that you make $50,000 and your spouse makes $250,000. Well, you're both accredited investors at that point because together, combined, it's $300,000. All right, so that's rule number one for individuals: $200,000 as an individual, $300,000 as a couple. The next rule, and this is one or the other. You don't have to have both. Right? It's either that rule, which is the income rule, or you have a net worth requirement. And the net worth requirement is that you have $1 million in investments, not including your primary residence. All right. And when I say investments, I just mean assets, right? So you have $1 million in assets, not including your primary residence. That one's kind of interesting. I could do a whole show on people spending way too much on their primary residence when they could have an opportunity to be an accredited investor. So we're not going to get into that too much right now, but it's one of those two rules, right? So you either have this net worth requirement, $1 million, not including primary residence, or you have the income requirement and you make $200,000 individually or $300,000 collectively as a couple. And that is the general terms for accredited investor. Now, they've recently expanded that just a little bit, right? And we'll go ahead and link to that report that updates the accredited investor status, qualifications, and requirements. It came out from the SEC last year, but they are expanding that a little bit. And thank goodness, we don't come up with these rules, right? This isn't the rule that Michael Holman has to invest with me. This is the SEC, right? This is the government. They set these rules. To be honest, whether you like it or not, there's some reasoning behind the accredited investor. I must admit I get a little frustrated by the rules because I think some of the people who could use the ability to invest in things like real estate the most, right, are the ones who are excluded from these investments. But like I said, I don't make the rules. That's what an accredited investor is. But they have expanded the definition. So there's some qualifications, some certifications that you can have that qualify you as an accredited investor. So I would take a look at those, right? Being an accredited investor is a really, really beneficial thing. I mean, it opens up so many opportunities of investments that you're never going to get to not as an accredited investor. So I highly recommend one of your goals, if you are not an accredited investor, one of your goals needs to be become an accredited investor. It will open up so many investment opportunities for you. Now, those investment opportunities, they're not as easy to deal with. They're not as liquid generally as the stock market, but they are infinitely more lucrative than things like the stock market. So become an accredited investor if you're not. If you are an accredited investor, you need to make sure you're an accredited investor, check those rules, check the SEC guidelines, and start investing in things that make sense. Real estate, right? Start investing in things that are actually going to start bringing you cash flow, appreciation, tax benefits, right? It's reasonable to get a 15, 20% annual return on your investment through real estate. It happens all the time. I mean, we don't even look at a project that is going to be under about a 15% annualized return. If it's a development project, it's not even on our radar. We just pass, right? And so being an accredited investor and understanding these syndication rules, very, very important, right? It's going to get you off on the right foot. It's going to allow you to start siphoning through potential investments a lot quicker, right? If you're not accredited, don't waste your time with 506C deals. It's not going to happen. You're not going to get in. And if you do get in, it's because you lied, and that's definitely not a good thing either, or somehow you got around the attorney. So if you're not an accredited investor, start targeting 506B deals, and it's going to require some more effort. You are going to have to go out and find the sponsor because they're not allowed to come find you. You have to find them and invest with them if you're not accredited. If you are accredited, then it's time to start vetting the sponsor, right? You have a lot of deals out there available to you, but go ahead and start vetting the sponsor. Start building the relationship with someone so that you can make those investments and that you can increase your wealth, your generational wealth through real estate. Thanks for joining today. Glad that you could be a part of the show with me, and tune in next week for another episode of the Executive Real Estate Investing Show.
Thank you for listening to the Executive Real Estate Investing Show. Ready to learn more? Go to executivereishow.com for more episodes and resources to help you create generational wealth through real estate investing. That's executivereishow.com.